Hey everyone, welcome back to The Explainer. Today, we are digging into a massive financial contradiction. We're investigating Corpay, trading under the ticker symbol CPAY, and breaking down their latest Q2 2026 earnings report. Here's the situation. We've got incredible top-line growth, doing battle with a really surprising drop in actual reported profit. So we need to follow the money today and figure out exactly what is going on beneath the surface.
Okay, let's dive into this. A stock doesn't just climb 56.49% in a single year by accident, right? In the lead up to this earnings report, Corpay's stock went on an absolute tear. We're talking up over 37% in 6 months and over 24% in just 3 months, skyrocketing to a massive $413.92. Now, when you see momentum like that, your first instinct is probably, wow, this company must be flawless, they are hitting on all cylinders, and Wall Street is just rewarding perfection. But as we're about to see, the story gets incredibly complicated the second you crack open their income statement.
So here is the central contradiction of our explainer today. On one hand, Corpay just reported that their adjusted earnings per share absolutely exploded, up 36%. Honestly, if you stop reading right there, it looks like an obvious buy. But wait, look at the other side. Under generally accepted accounting principles, or GAAP, their actual net income fell by 13%. Wow. So which number should we actually believe here? The explosive adjusted earnings or the falling GAAP profit? To solve this mystery and figure out if Corpay is a buy, a hold, or a sell, we have to start at the very foundation. Section 1. The alibi. What does Corpay actually do? Fundamentally, Corpay is a corporate payments and expense management company. Their core services cover corporate payments, fuel payments, lodging, and cross-border transactions. But the absolutely crucial thing to know here is their strategic shift. Management is actively steering the ship toward corporate payments and spend management. And you know what? It's working. It has driven 5 straight quarters of double-digit organic growth. But the big question is, can a stock that's already up over 50% really keep this kind of momentum going? Well, just look at this jump. Q2 2026 revenue came in at $1.338 billion. Compared to the exact same time last year, that represents roughly 21.5% growth. And even better, their organic revenue growth was 10%. This right here is our first major green flag. They are driving some very serious top-line expansion. Now, let's break down these adjusted numbers because they are absolutely glowing. Adjusted EBITDA up 24% to $767.2 million. Adjusted net income up 27% to $464.4 million. And that adjusted EPS jumped 36% to a picture-perfect $7 per share flat. If you're only looking at these metrics, the story looks totally flawless. It looks like a company firing on every single cylinder. And yes, these numbers are fantastic, but we're not quite finished. This is where our investigation comes to a screeching halt. If revenue grew by over 21% and adjusted earnings jumped 36%, why in the world did the actual GAAP net income drop from $284.2 million last year down to $248.3 million this year? That is a 13% decline. Even GAAP EPS fell about 7%, down to $3.70. Seriously, how does a company grow revenue by over 20% and somehow walk away with less actual net profit? Well, here is your smoking gun. $100 million. During the quarter, Corpay recorded a massive $100 million charge tied to a preliminary settlement with the FTC's Bureau of Consumer Protection. That single line item completely dragged down their GAAP profitability for the entire quarter. It totally explains that massive gap between the rosy adjusted numbers and the actual reported numbers. So the crucial point is this. We now have 2 completely different pictures. Adjusted EPS is up 36%, while GAAP EPS is down 7%, which brings us to the ultimate question for us as investors. Is the adjusted number telling us what the business really earned by stripping out a one-time annoying legal penalty? Or is it just a really convenient way for management to make a messy quarter look a whole lot better than it actually was? Hold on to your answer for a second, because before we judge that, we need to look at a metric that reveals the true day-to-day health of their operations. What's super interesting here is the 16% figure. This is the organic growth rate of Corpay's corporate payment segment in Q2. Now, why is this so vital? Well, it proves management isn't just buying up other businesses to magically inflate their overall growth. The core engine of the company is expanding naturally. More businesses are actually using Corpay for their everyday corporate spending, and that leads to more payment volume and highly recurring economics. This right here is the ultimate bull case.
But you know us, we always have to look at the other side of the coin. If the bull case heavily relies on businesses spending more money through Corpay systems, well, what happens if corporate spending slows down? This company doesn't operate in a vacuum. It operates in the real world, which means we have to zoom out and look at the macroeconomy.
Corpay isn't fully insulated from broader economic trends. Things like overall corporate spending, fuel activity, cross-border payments, business travel, and, of course, interest rates, these matter deeply to their bottom line. If companies start cutting expenses and traveling less, payment volumes weaken. Simple as that. So when you buy CPAI, you are actively making a bet on continued corporate economic activity. And to survive any kind of turbulence there, you'd better have a rock-solid balance sheet.
Which brings us to the debt test. Corpay exited Q2 with a debt leverage ratio of approximately 2.55 times. Now, to be completely fair to them, they didn't mention they strengthened their balance sheet recently with some debt refinancing, and they actually bumped up their revolving credit facility to $3.7 billion. So the liquidity is definitely there. But still, 2.55x leverage is a number sophisticated investors really need to keep a close eye on.
Leverage is basically a double-edged sword. On one hand, the risk is that if earnings start to fall, that 2.55x leverage can severely amplify the pain for shareholders. But on the reward side, management is aggressively trying to amplify returns. In Q2 alone, they repurchased about 1 million shares for $321 million. That shrank their outstanding shares by around 3.28%. I mean, management is literally putting hundreds of millions of dollars right behind their own stock. Just a quick note for anyone out there looking for income, CPAY is absolutely not the stock for you if you want a high yield. They don't pay a dividend. Capital is focused heavily on share repurchases and reinvesting right back into the business. The whole thesis here relies entirely on earnings growth, free cash flow, and management shrinking that share count over time. The real question is just how fast they can grow the underlying value of each remaining share. And clearly, management believes they can grow it very, very fast. Just look at this number. 28%. That is the midpoint of management's raised 2026 adjusted EPS guidance, where they're projecting earnings between $27.15 and $27.55 per share. They even raised their full-year revenue and GAAP net income guidance. Corpay is emphatically telling the market that the good times are far from over. They fully expect this impressive growth to just keep rolling. But here is exactly where beginners and professionals diverge. A beginner looks at that 28% and asks, hey, is Corpay growing? And the answer is a resounding yes. But a seasoned investor asks a much tougher question. Is Corpay growing faster than the stock price already assumes? Remember, financial markets do not reward you just for growing. They reward you for beating what is already priced in. And let me tell you, a whole lot is already priced in. CPY closed at $417.13 on August 21st, placing it just 2.07% below its 52-week high. Wall Street is definitely not asleep at the wheel here. Investors already know all about the massive revenue and EPS growth, and the stock's 56% one-year climb tells us that expectations right now are sitting sky high. And this brilliantly illustrates the exact battle happening around this stock right now. Let's break down the scorecard. On the bull side, you've got staggering 21% revenue growth, a 36% jump in adjusted EPS, 5 straight quarters of double-digit organic growth, and those aggressive share buybacks. But then, on the bear side, you've got a 13% drop in GAAP net income thanks to that $100 million FTC settlement, you've got meaningful 2.55x debt leverage, and you've got sky-high expectations sitting right near a 52-week high. This really isn't a battle of a good company versus a bad company. It's a battle of strong growth versus incredibly high expectations. Which brings us to the really uncomfortable truth of our investigation today, perfectly captured in this quote from our source material. It says, the biggest risk isn't necessarily that Corpay's business collapses. It's that Corpay continues doing very well and the stock still disappoints because expectations were even higher. Think about that for a second. Corpay is clearly executing, but if you pay a premium price for absolute perfection, any tiny stumble in the macroeconomy or a slight miss in earnings can send the stock tumbling, even if the underlying business remains fundamentally healthy. So what is the final verdict here? Well, the business quality, the growth, the cash generation, and the buybacks are undeniable strengths. Those are strong green lights all the way. But we definitely have to monitor the yellow lights, specifically the debt leverage and those regulatory risks highlighted by that massive FTC charge. Because of the pretty demanding valuation, our source material concludes that CPAY is a watch or selective buy. Basically, it is not a stock to just blindly chase after a 56% rally.
The smart play might be to wait and see if they can maintain that double-digit organic growth without expectations getting totally disconnected from reality.
I want to leave you with this final, provocative thought to chew on today. Are you investing in a great company, or are you just buying a great company at the wrong price? Trust me, that is the difference between making money and losing it in the stock market. Think about that as you review your own portfolios. Thank you so much for joining me on this deep dive into Corpay. If you loved dissecting these numbers as much as I did, make sure you join me for our next explainer, where we'll be launching a full investigation into Waters Corporation, ticker symbol WAT. You seriously won't want to miss it. Keep learning, stay focused, and I will catch you next time.